You're listening to the Commit to Wealth podcast with Juan Vargas, episode number 1.
Welcome to the Commit to Wealth podcast, providing you with the expertise and proven strategies to scale your real estate business. Learn from today's top real estate entrepreneurs and build your own wealth. Your legacy and commitment to wealth starts now with your host, Juan Vargas.
Today's guest is Jeff Greenberg. Jeff has over 40 years experience in management, staff supervision, development, and training. Jeff has been investing in multifamily and student housing assets in emerging markets across the nation since '07. He focuses on all aspects of projects, including underwriting, acquisitions, investor relationships, contract negotiations, business system development, business management, and asset management. So with that said, let's get Jeff on the show.
And now, welcome this week's entrepreneur.
Welcome to Commit to Wealth. I'm Juan Vargas, and our guest today is Jeff Greenberg. Jeff, welcome to the show.
Well, thank you. Thank you for having me.
That's awesome, Jeff. Where are you calling us from?
I'm in California, Ventura County, which is just outside of LA.
Okay, awesome. And so you're investing there, right? It's really cheap there, huh?
Yeah.
Find great deals there, huh?
Yeah. No, I don't. I'm afraid I don't invest in California. Not at this point.
Okay. Well, why don't you give us, a little bit about your background? Tell us, how you got started in real estate, and just kind of go from there.
Okay. I got started, I guess, about in 2007, looking at single family homes, and it wasn't a great time to be buying single family homes. We were looking at REOs, bank-owned properties, and the banks weren't letting them go. So it wasn't a great opportunity to do it that way. And I bumped into somebody that was doing multifamily properties and got kind of excited about the extra zeros behind the numbers, and got excited that I could also leverage other people's money. So I started looking into the multifamily realm and the commercial real estate, just doing it that way.
So Jeff, did you go directly into multifamily, or did you start off with single family like most of us do?
I didn't. I went directly into multifamily. I didn't. The only single family home properties that I've bought were my own personal residences.
Okay.
Other than that, I just went in straight into commercial.
What were the reasons for jumping directly into multifamily? Was it because you saw right away the benefits over single family, such as economies of scale and property management? Tell us why you were confident enough to make that jump.
Well, a lot of it was I was in the middle of a divorce and realizing that there wasn't a lot of money left over from my retirement. My ex was going to get my house. And so I figured, well, I got to make some money somewhere. And if I just did it with the money that I had, it was going to be a long road as far as doing it with single families. And like I said, I liked seeing all the extra zeros on the multifamily properties, and also that I could leverage other people's money, that I could use my money as well as other people's money to get to my goals.
Got it. So talk about, what was your first multifamily deal like? Where'd you find it? What kind of market? How did you find it? And just kind of tell us a little bit about that.
The first property that we got it from a broker relationship. Actually found the broker through some properties on LoopNet. We looked on LoopNet. We looked to try to make some of those properties work, and they didn't. But I established a relationship with a guy that lived in Texas, but actually was born in California. So we kind of got a bond going, and he found the property. It was actually through a relationship he had with a bank that they contacted him, he contacted me, and we bought what was 5 fourplexes. So it was 20-unit property, and it was in South Texas, about 35 miles from Brownsville, from the Mexican Texas Gulf. So that's basically where we started, was with a 20-unit property. They were built in 2007, and we bought them in 210. So they were pretty new properties.
What was your strategy like for this property? And did you get a good deal because it was the bottom of the market in 2010?
It was a good deal. It was a good deal, not as good as we had thought, because there wasn't a lot of value add that we could bring into it. They were 100% occupied. As I said, they were three years old, so they were fairly new. We thought we were going to raise rents and do a RUBS program, billing back utilities, and that didn't go over too well. The raising of the rents was slow. The billing back of the utilities met with a lot of resistance, and so the property, we kept it at 100% the whole time, but it didn't increase a huge amount in value. So it was an education. It was an education. We didn't make a lot of money out of it. Our investors got a preferred return, so the investors did fine, but not exactly what we had hoped for. But as I said, it was an education.
Okay, right. So what is a preferred return? Can you explain that a little bit for the listeners that don't know exactly what that is?
Mm-hmm. Yeah, typically what we'll do is on a syndicated deal, or when we bring in investors, we will give them somewhat of a preferred return. Now, what that means is they will get that percentage of return before we get any cash flow. And typically, or on this one, it was like an 8% return. And so the property had to be cash flowing at least 8%, an 8% return before we saw any. And pretty much for the duration of the hold on this property, we never got past that 8%. And so we really didn't get any cash flow during the hold. So it was most of the time we were working for nothing, for the educational value out of it.
Right. So talk about the benefits for the investors. Why is it beneficial for them to get an actual preferred return versus not getting a preferred return?
Well, it's a safety net for the investors. If we don't get what we project that we're going to get, then they still get their return. So on the low side, it protects them. And once it gets up above that, then we're splitting the rest of it. So it's kind of a protection for them. And a lot of investors like that preferred return. They believe it's an incentive for us to work harder to get higher returns. We're going to work as hard as we can anyway to get those returns, but it does make the investors feel a little bit better that we have to make the property perform before we get any of the cash flow.
That makes sense. So they're getting that 8% return. What kind of splits are you doing? Is there a certain number of splits that you do, after the 8% preferred return?
It's going to depend on the deal. We've done anywhere from a 75-25. That's 75 to the investors, 25 to us, down to a 60-40, 60 to the investors and 40 to us. But it's going to depend on the deal. And a lot of times that depends on the experience of the syndicator. We started out with the 75-25 and have worked our way up, where people are more willing to go those kind of splits because of our reputation and what we're offering investors. But it's going to depend a lot on the deal itself as well.
Okay. Did you talk about the financing? Can you go over that a little bit? Like, what kind of financing did you get for this? Did you go to a traditional bank? Was it some kind of, special kind of lender that you actually used? Kind of go over that a little bit.
Well, the first deal was a very small bank. I think they had 2, maybe 3 branches. These were in Texas, and this bank was actually the holder of the existing loan. We were buying from the developers. The developers got stuck with the properties during the recession, and they held on to them for the 3 years. And they were lousy property managers. They were lousy owners. They had developed the property. The bank wanted them out. And so we went with this private bank, and they set it up kind of as an assumable. an assumable debt, but it really wasn't because our terms were totally different than the terms that the developer had. So it really was a new loan, but they liked us. We interviewed with them. They wanted us in there. They wanted the owners out. And so we were able to get, I believe we got 75% debt on it. We just had to raise the other 25.
Great. So you mentioned assumable. For those of the listeners that don't know exactly what that is, what does that mean, assumable?
Well, typically an assumable loan is you're going to assume the terms of the existing loan. Assumable loans are not real easy to get. You have to qualify. If the lender currently has a high net worth individual or company on the hook, they're not real likely to be willing to trade to somebody that doesn't have equal or better credentials. And so typically the assumable debt is more difficult to get. It was just in this case, they would do anything they could to get them out of there and us in, because we honestly wanted to be there and they didn't want to be there. So the bank was working with us and pretty much did whatever paperwork they needed to do to get us in.
Okay, sounds great. What kind of experience did you have prior to this? You mentioned this was your first deal. You didn't even do single family, so you went straight into multifamily. What kind of experience did you have, and how easy or how hard was that to actually get into the first deal?
Well, it wasn't difficult, but we had really no experience or very little. My business partner who's up in Alaska, she had owned some single family homes, so she had a little bit on that. We both were invested as passive investors in a $20 million 700 unit deal, and the bank was impressed with that. So that did give us some credibility as far as our motivation and our interest in commercial real estate. But as far as actual experience, we really didn't have any. We had gone the guru route and had gone to a lot of training sessions, and the bank did like that as well. It showed that we had interest in getting into the commercial real estate. So I believe that helped, but we really had very little ownership experience.
Yeah, well, if you actually piggyback on somebody else's experience, somebody that's already been there, done that before you, that will actually go a long way and give you more credibility, like you mentioned. Now since you didn't have to actually piggyback on somebody else, you had prior passive investment experience, and so that gave the lender a lot of credibility and give you a lot of credibility for that. So that's great. Can you talk about the management on that? You mentioned the property wasn't in your home state, it was in Texas. So how were you able to manage that?
Well, at first it was my broker that sold us the property. He was managing it, and that probably was a mistake. And it was a mistake for both of us because that wasn't his primary source of income. And he lived or he worked 35 miles away from the property. Every time he went to the property to show the property, he was losing time. He would lose two hours of his business, and he was really losing money on us. And he started getting sloppy, doing a lousy job, letting anybody in there that happened to have money with them. And so that the property started to go downhill. We ended up with 6 vacant units out of 20. Ended up having to fire him as the property manager. Went through one more before we actually found the property manager that we ended up going with for the next 3 or 4 years after that. But it took us till we got to that third property manager. It is difficult in smaller properties to get good property management, and it's extremely important. People don't realize how important the property management end is.
So you mentioned it's difficult. So what's the target unit size where you should actually go for, where you have a professional third party property management? I mean, is it 20 units and above? Is it 40 units and above? I mean, what's What's the actual number that you recommend?
Well, if you're buying out of your local area, I would get a property manager no matter what size units you get. But the optimum size for having, say, an on-site person. See, I didn't have an on-site person on this property. The property manager. She showed up as needed for collections or for showing the property, and her husband did the maintenance, and he came when he was needed. Typically, you want above 60, maybe even 75 units to actually have an on-site person where somebody is there all the time in the office, as well as a full-time maintenance person. So 60 is probably the minimum. Really, you want 75 and up to really have full-time people on the property. That's my preference. As far as you just don't seem to have the expertise when you have the smaller properties.
Great points. What was the purchase price for that property? And if you don't still own it, what was the exit price?
No, we bought the property for $1,080,000, I believe, $1,080,000, and we sold it 6 years later. We tried to sell it at year 4.5 and couldn't get our price, but we sold it 6 years later at $1,250,000, I believe. So it wasn't a great profit for that period of time. It was slow growth community. Rents we slowly raised, but we stuck with our number. At year 4.5, we'd established what number it was going to take in order to get a decent return for the investors. And it took us 1.5 years to get that number, but we stuck with it. In fact, we extended the loan in order to not come down on it. There just wasn't enough value added to the property to make up for what it was costing us to sell the property.
Overall, it's a great learning experience for your next one, right?
Absolutely. No, it was a fantastic learning experience, and we didn't lose money. Investors made money. We had happy investors, even though we didn't get them what we promised. But we've got investors that are still with us from that property because of the respect they had that we ran that property for 6 years without getting any cash flow. We learned a lot of what not to do and what we don't want to look for. So it was a great learning experience. If you can come away from a learning experience and didn't cost you any money, that's a win.
That is definitely a win. So do you recommend somebody else, if they're starting out to look for a 20 unit, 15 unit, 20, 30 unit? Do you think that's an ideal first property where they can actually learn?
Well, it's probably a good opportunity if they're using their own money and they're not sitting there trying to make money for their investors. If somebody has enough money that they can go and buy a 20 unit, or maybe they could do a 1031 from some other single families into, a 20 unit, that's fine. I do recommend that if they're going to, if they can do it in their local area, and then they could be their own manager. That's going to save them a lot of money. They're going to go through a lot of learning pains on why they probably don't want to be a property manager, but it's certainly a good learning experience. If they're going to do it away from their local area, then you're going to end up, getting a property manager. The smaller the units are, the probably harder it is to get good management.
So in summary, I would say for a smaller multifamily property, I would say if you're going to do it, then find one that's close to you, find one that's local. Do you recommend managing them yourself?
I don't like managing properties. It's a difficult task. It's going to depend on what the goal is of the particular person. They've got a full-time job and a family. They don't have time to be messing with that. They're probably better off getting a professional management. It's going to cost them money, so it's going to cut back on their cash flow. But it's going to depend on the person as far as, what their goals are and what their abilities. It's hard being a property manager and telling somebody that just lost their job, that they have to move out because they can't pay rent. You got a mom with a kid or something, you got to kick them out. I don't know. That's a pretty tough thing to do, but either run a business or not. If you're going to run a homeless shelter, that's a whole different thing. You have to decide. And for some people, that's going to be pretty hard to do. Sometimes it's a pretty cold thing to do, but you have to decide if it's a business or if it's a charity.
Right. That ultimately does depend on the investors themselves and what their goals are. Some people are control freaks and want to do it all themselves. If you have the time, if you have the means, the capital to be able to buy one that's local, and if you want to actually get hands on and roll your sleeves and get in there and get dirty, not saying physically like maintenance wise, but there's going to be the calls. There's going to be a lot of little issues that are going to arise. It will happen. So you have to be willing to do that. So what about your next property after this one?
Well, let's see. The next one we got into, that was our Houston property. That was a 62 unit in Houston. And that was a totally different story because that was a 1960s product. That one was 85% occupied. That one, the previous owner had bought it out of foreclosure. There was 10 units down pretty hard. And so that was a whole different thing. And that one, we ended up getting that one for $1.3 million. So we got it for a couple $100,000 more than the other one, but it was 62 units. And, there was all different issues with that one. But that one, we got professional property management. And essentially, we didn't do much besides meet with her once a week. And then we cut that back to once a month once things got going. But she did all the work. She just let us know when there was a problem and pretty much solved it.
That's awesome. How were you able to find this property, the 62 unit?
That one, it's kind of funny because this one happened to have been brought to me by the same broker. Even though he works out of McAllen, that's, if you're familiar with that, that's where Texas hits the Mexican border, or Mexico. That's on one side. And then he was just opening up an office in Houston. And he was doing some cold calls, and he happened to go into a 150 unit property, met the owner and asked if the owner wanted to sell. The owner said no, he didn't want to sell that property, but he would take the broker over to another property that he'd be interested in selling. And that was the 62 unit. My broker actually negotiated the price. I was the first one he called. And I've always asked why I was the first one, because there was people that he knew that could have paid all cash for it. There was people that he had known for longer than me that he could have called them up and they would have bought it. But he called me and told me about the property. And within a week, we had it under contract. And we had brokers from around the area saying, hey, I didn't know that thing was on the market. I didn't know it was for sale. Well, it wasn't. It wasn't. We bought it before it was ever placed on the market. So that was a super opportunity. Great, there was great opportunity with that relationship. But I didn't let him manage that one. He wasn't going to manage it.
You learned your lesson, right?
Yeah, but yes. So even after I fired him as the property manager, he still was my friend. So that worked out okay.
So that just shows you the power of building relationships, right?
Absolutely. The power of relationships is keen. And that one we sold 3 years later for $2.7 million in 3 years. So that one was a total opposite of the other ones. Our investors got kick-ass returns on that one, and I don't know that I could ever top those returns. But in 3 years, they got 120% return on their money.
That's great. That is very awesome.
So that was impressive.
Yeah, that is. So what is your plan? You said you sold it in 3 years. So what was your original plan going in? Was it 5 years, 7 years? What was your plan?
Yeah, original plan was 5 years, but Houston was doing very well. We bought it at about a 9.7 cap, and Houston was at about a 6.5, 6.7 cap rate. And somebody mentioned, hey, why don't you see about selling it? And I said, okay. I told the broker if he wanted to list it for 2.9, and if we could get 2.6, we would go for it. I had projected a 2.1 to 2.3 sale price in 5 years. And I told him, if we can 2.6 in 3 years, it was worth it to pay the $100,000 prepayment penalty we had to pay. That $100,000 was nothing compared to the profit that we had made. So we decided to sell in 3 years, mainly because we could get a great deal for the investors. And the other thing is Trump just got into office. I didn't know what was going to go on with the economy. I figured let's take it and run. And I queried my investors, asked them what they thought, and they said, go with what you feel. And so I said, okay, let's play with it and see what happens. And we got this offer, and I said, okay, why not? We went and did that, and then half of them went into my next deal, which was a property in a property we bought in Georgia.
Okay, that's awesome. So you actually did pretty good on that one.
We did fantastic on that one.
Fantastic, that's for sure. So why Houston? I mean, what do you see anything now? Like, what is that a market that you will actually look into, even now after the floods and after we had like some of the oil downturn? Would you still be interested in Houston?
Oh yeah, I'd go in Houston. Houston's a great market. Houston was doing fine even when the oil downturn. The properties that were having trouble were there was some new A and B caliber properties that were coming on the market, and they were having trouble leasing up until the floods came. Once the floods, now they're probably all filled up as well. This was a C property. We didn't seem to have a problem keeping it full. There's so much going on in Houston. Right near where we were at the Hobby Airport, Southwest was adding 7 new terminals. There's cruise ships coming into the harbor in Houston. There's container ships going down there. Besides oil, there's petrochemical. There's also finance districts, medical things going on. Houston is a very diverse market. They learned their lesson from 1980 when the oil market really kicked their butt. So they learned their lesson. They diversified, and it's a strong market. If you can get a good deal in Houston, you just have to be careful. There are areas of high crime, and I would be very cautious of those. But still, the market itself is a good market.
Right. And I agree with you on that. I'm actually here local in Houston, and I see, I keep hearing, I keep hearing about, a lot of investors, they shy away from Houston because of what you mentioned, the oil downturn and then the flooding. But really, because there's a lot of investors, shying away, I think it becomes a great opportunity for those that did sneak in past them and then capitalize on opportunities that they otherwise wouldn't have had. And like you mentioned, there are pockets of, crime, but I would say, you would probably agree with me on this is, any city you go to, there's going to be pockets of crime. There's going to be, your A class, area and your B class and C class. That's pretty much national. So you have to make sure you do your due diligence on that and find a good area for sure.
Right. And being local or having somebody local in the area is always good. When I first started talking about Houston, I would hear people say, don't go to Houston unless you know Houston. Okay. So we found people that were local to Houston to go and talk, besides the brokers, to go and check out areas. We do that all the time now, is no matter where we are, we find somebody local or a property management company that will go look for us. We don't listen to what the brokers have to say because obviously they have a motive for telling you, oh yeah, it's a good area. So we do a lot of that where we reach out to people and ask them to get an opinion on particular areas as far as the crime, where the path of progress is going. A lot of that.
I want to touch a little bit on the investors. How do you find your investors, and what do you do to actually talk to them, and I know you got to build relationships, but for those listeners that don't understand exactly how it works, can you explain how, what the process is like and how you go about that?
Well, because I do what's called a 506B offering, I can't do a general solicitation. I can't go and make an announcement either on Bigger Pockets or on the web and say, hey, I got this offering, I'm going to give, a such and such return. And, hey, come on and be my investor. You can do that in what's called a 506C offering, but I have not done one of those yet. So I do typically a 506B offering, and which means that either myself or one of my teams have to have met you personally and have talked to you personally and have established a relationship. Now, a lot of those relationships come from all different areas. They come from people I have met at conferences where I've talked to people about what I'm doing, and I say, hey, let's have a conversation, and we'll sit down and talk about what their goals are, what their interests are, what their risk tolerance is, what kind of things they want to get involved in. So I establish this relationship. And like I said, they could be from conferences that I go to. I used to run 3 real estate clubs. Now I'm down to 2. I participate a lot in Bigger Pockets. I go to a lot of meetups where I meet people and talk to people. This is probably my 7th or 8th podcast that I've been on. So people find me on different podcasts, just all different ways of exposing myself out to people so people can look at it and say, hey, I like what he says. I'm interested in finding more. They contact me and then we go from there. But typically that's where most of my people have come from. A lot of people start out with friends and family. I had friends and family that really weren't interested in doing it. In fact, I'm on my 6th syndication right now, and my sister and my brother-in-law, this is their first time they're investing with me. So I finally got them convinced. But otherwise, it's basically been people that I've met, and on one media or another.
So what everyone always says is, go with the low hanging fruit, and the low hanging fruit is usually your friends and your family. They're usually the ones that you can actually convince, and they already know you, and there's a trust factor there. So in this case, it didn't necessarily work like that. It took them like 6. You said 6 indications to actually get there.
Yeah, but it's my brother-in-law is very conservative, and it took him some convincing. But the thing is, if you have friends and family that have money and that are interested, you talk to them. You let them know what you're doing, and if somebody expresses interest in it, you go from there. In my case, it just didn't work that way. It just ended up that other people that I had met through the real estate channels that have invested with me, and then they've referred to other people that have invested with me.
What did you have to sacrifice to get where you are today?
A lot of time. For a long time, there was a lot of things that I kind of sacrificed. I essentially gave up television. I hardly watch anything. I might watch just something before I'm going to bed. I tried not to sacrifice my family time. I mean, by the time I started, my kids were all grown up. So they had their families, so there wasn't a big sacrifice on that. As I mentioned in the beginning, I had just when I started, I had just gone through a divorce. So this didn't cause the divorce, but this started after the divorce. So I had a lot of time available. And the word of wisdom that I would give people on this is, when your kids are growing up, that's only happening once in their lives, and I wouldn't want to give that time up. But you need to make sure your spouse is on board. If your significant other is not on board with it, it could end up with a lot of difficulties, because it's time consuming, especially when you're beginning. You're going to spend a lot of time, a lot of effort doing it, and you need to make sure that you're you're not doing battles in order to get the work done. It's got to be something you enjoy doing. It's got to be a challenge, and you'll make some sacrifices.
I agree with you on that one. You have to make sure if you are married or even if you have a girlfriend, boyfriend, to actually get your significant other involved. Show them the benefits and tell them that, the reason why you're doing it is for you both, or your family. And so, but yeah, definitely you have to make sure you get them on board. If not, then it's going to be, it could be a long road.
Yep. And the one thing is if you listen to the gurus at different seminars, they're going to tell you how easy it is, and in 6 months you're going to be making money and all this. And I believe they're really doing a disservice to people, because people go in with an expectation that it's going to be easy, that they're going to get it done, they're going to be making all this money. And for most people, it doesn't work that way. For most people, it's a lot of hard work, it's a lot of time. And if you go into something realizing that, then maybe you have a better mindset. Of course, there's always some people that just fall into a deal and all of a sudden they're making money right off the bat. But I would say for the most people, it's a lot of time and a lot of effort, certainly worth it, but go in knowing that there's going to be a lot of work and be prepared for that.
That is so true. What do you believe is an investor's biggest fear, and what can they do to overcome it?
Well, I believe that the biggest fear is the fear of failure, the fear of losing their money, losing somebody else's money. Nobody wants to fail. But I think it was might have been Robert Kiyosaki that went and said, he wanted to, or I guess his rich dad probably told him, he says, hurry up and fail, because then, the faster you fail, the sooner you'll be successful. If you don't try anything, then you don't have to worry about failing. And if you've never failed, you probably haven't tried, haven't pushed yourself. You have to push yourself. Now, I wouldn't want to see somebody throwing all their money at some deal and then being broke and in trouble. But failure is part of trying. If you don't try anything, you're certainly not going to fail, but you're certainly not going to succeed either. So the fear of failure is probably the big thing. And if you can get over that and realize, or have yourself some kind of safety net. And you mentioned it earlier, as far as working with somebody with experience and, riding on their coattails, that you have less chance that you're going to be taking a major hit if the deal does fail, or teaming up with somebody else where you can split the risk, where you're not risking all of your money, both of you are putting something in, and a loss isn't going to hurt you nearly as much as a total wipeout. So
you guys don't be afraid to fail. If that's what it takes, then, it's not saying that go fail on purpose. That's not, what we're saying here. What we're saying is to go out there, have the right attitude, have the right mindset, and do your best. And if you do fail for some reason, then you just fail and you pick yourself back up and keep on moving. You're going to learn from your failures.
You learn from your failures. So hopefully you're not going to do the same thing next time.
Right. Exactly. What's next for yourself, and what's next for your company, Synergetic Investment Group?
Well, we're still on the expansion mode. We're, I hope to have, in the next couple of years, at least $100 million under contract, or under control. But it's just, pushing on. It's a difficult market right now. And I think everybody that's in this business knows that the prices are so high. We've had a great market for the last 9-10 years in the multifamily. And we're very cautious about making sure that we get value add properties to increase value. But we're still expanding. I have a team of people and acquisitions and analysis teams that are looking for more properties. We hope to double what we did in 2017, and hopefully within the next couple of years, as I said, have at least $100 million worth of properties under control. And we're pretty excited about the future.
That's great. Where can the listeners find out more about you in Synergetic Investment Group?
Well, we have a website. They can go to synergeticinvestmentgroup.com or synergetic.ig.com. I'm also online on Bigger Pockets all the time. I'm always communicating with people there. Those are probably the best ways to get a hold of me.
Okay. Well, listen, Jeff, I just want to thank you for being on the show and thank you for sharing your knowledge with us and our listeners, and wish you the best.
Well, I thank you very much for having me. And, I'm always interested in helping people out. There were people helping me out on the way up. So I'm always willing to give back, and I'm always looking for people to partner with. Thank you very much for what you're doing, and hopefully you have the best success as well.
Thank you very much.
Thank you for listening to today's show. Head over to committowealth.com now and access the wealth of information Juan and his team make available exclusively to you, the podcast listener. That's committowealth.com, where wealth begins by giving and is created by having a defined purpose.